about credit, you're talking about buying something now that you're going to pay for later. Okay, so credit card, loan, an installment plan from a store, just basically anything that you buy now, you take home now, you pay for in the future. Debtors are people using credit, owing money, or are in debt. So anybody that has purchased anything that they're paying for later is a debtor. It sounds negative, right? It sounds like a negative connotation to say somebody's a debtor, but if you ever took out a car loan, you're a debtor. If you ever had medical bills and you had to make payment arrangements, you're a debtor. It's not necessarily negative. Creditors are the organizations or people who extend credit. They're owed money. Assets are everything you own outright that has value. And that having value is important. I own my flip-flops outright, but I'm pretty sure they don't have any value. You know, I've been wearing them for about a year. I don't think anybody would pay me any amount of money for these things. Okay, no value. So they're not an asset. I mean, to me, they're an asset because I don't want to walk around on barefoot and get glass in my foot, but in general, they're not an asset. It has to have value. So your house, your car, personal possessions, furniture, jewelry, appliances, they have value. Bank accounts and the amount of money that are in the bank accounts, if you have stock, things like that. Now, your assets are limited in that if I own a home, it's an asset as long as it's worth more than I owe on it. If I owe more than it's worth, it does not actually have any value. Same thing with my car. My car, as soon as you finance a car and you drive it off the lot, you owe more than it's worth. Did you guys know that? It depreciates immediately. And so as soon as you finance a car, it's now no longer worth what you just financed it for 10 minutes ago. The minute you drive it off the lot. So right now my car is not an asset because I owe more than it's worth. However, the furniture in my house is paid off, so it's an asset. Now it would not be worth probably as much as I paid for it, but it still has value. The money in my bank account is an asset. Jewelry, if you gold, silver, jewels, those are assets. The $2 necklace I got over at Target probably is not. You know, the beaded, whatever, but you get the idea. Your earning power is your ability to earn money now and in the future, and your earning power is affected by several different things. Your job history, your level of education, and then also whether or not you're willing to go to work. I mean, if you don't even go out looking for a job, your earning power is very low. Your job history, your earning power is affected by the type of jobs you've had. If you've only ever had a long string of minimum wage jobs and you're not educated, they consider your earning power to be very low. However, if you have a long string of minimum wage jobs but you're in college, they consider that your earning power is higher because you're getting an education. So that can change all the time based on what you're doing in your life. And that your earning power does come into play a bit when they're determining whether or not to extend you credit, because they look at your current income and they look at your job history. If you are a job jumper, do you guys know what I mean by job jumper? People that don't stay in a job very long and go from one job to another, don't have considerably high earning power because you're considered to be sort of unstable. If you've been at your place of employment for 4 years, 5 years, and even if it's a low paying job, you've shown a lot of stability, it shows your earning power to be a little bit higher. So they look at things like that. Also your credit rating, which is your credit report card. You get a credit score, which we'll go into all that. But your credit rating is reported by your creditors. If you've never had a creditor, you have no credit report because nobody's reported anything. And what they report is your payment history. Are you making your payments on time? Are you making the minimum monthly payments? Are you paying a little bit more? Did you pay a little bit less? And then how much debt you have. Your total debt history gets reported, so the amount of total debt you have, things like that. And your credit is a legally binding contract, and it obligates you to make on-time payments. If you don't, companies can take legal action against you and take you to court and sue you and things like that. Now, they don't have debtor's prison anymore. They used to have that, debtor's prison, where they would put you in jail if you didn't pay your debt. But you can get wage garnishments, and they can take your assets and things like that. So you always want to pay. Okay, so credit reporting agencies. There are 3 major credit reporting agencies. Those are TransUnion, Experian, and Equifax. In general, they should all have about the same amount of information, or the same information, but they don't tend to. They tend to fluctuate a bit because perhaps one company only reports to 1 or 2 of them, and another company might report to all 3, etc. So your score can vary between the 3 companies. But what they do is they compile records on all users of credit, and those are used to determine your credit worthiness. You are assigned a FICO score. The FICO score was developed by a company called Fair, Isaac & Company, hence FICO, F for Fair, I for Isaac, CO for company. And they determined a mathematical computation that would assign you a score between 300 and 850. 300 is the absolute lowest you can go, 850 is the absolute highest you can go. And it summarizes a probability that you will pay your debt. Obviously, the higher the score, the higher the probability that you will pay your debt. That equals a greater credit rating. Anything below 650 is considered to be bad. Okay, 850 would be perfect. And we'll go over like the range of what's like really, really bad versus kind of bad versus iffy versus good and then really good kind of thing. Installment plans is a type of credit that is offered by stores and then some catalogs. I don't know if any of you get those catalogs in the mail that like it's got, you know, like shoes and clothes and random bath products and gadgets for your house or whatever, and the front of it like you've been pre-approved for financing, right? Have you seen those? Those are installment plans. Or if you go to a store and they have like furniture stores will do no interest for 6 months if you buy this new bedroom set kind of thing. Anything from a store is an installment plan if you get to take the stuff home that day. If you have to leave the stuff there until it's paid off, that's layaway. That's a little different. But if you get to take the stuff, but then you pay for it over time, and it's from a store or catalog, it's an installment plan. So even if you get like a store credit card, Target has a credit card, JCPenney's has a credit card, Sears has a credit card, Walmart has a credit card. I'm sure all the major department stores, Kohl's, Nordstrom, Dillard's, everybody has credit cards. Yeah.
Something's on layaway to keep it until you get it.
Yeah, layaway they keep it. Installment plans you get to take it home. But the store credit card is not a true credit card. Not like a Visa or a MasterCard. A store credit card being good only at the one single store is actually an installment plan. But it's kind of a revolving installment plan. So anytime you buy something from a store using their financing, it's an installment plan. You have to make a down payment sometimes, not all the time, but the down payment is a portion of the purchase price paid in advance or at the time of purchase. And it's either a set amount or a percentage of the total. You know, they might say 100 down for no matter what you buy, or they might say 10% down. And then you pay interest. Interest is the fee charged on installment purchases or any credit that gets added to the total price. And even when you see those ads for furniture where it says no interest for 6 months or 12 months or whatever, they're gambling that you will not pay it off before that time period is up, so they can charge you the interest. Because there's really no purpose for a store to give you an installment plan unless they're going to make money off of it. And the money that they make off of it is the interest. I mean, they make obviously the markup off the product or whatever, but they would make that whether they gave you the installment plan or not. You know, they mark up the shoes $50, then they're going to make that $50 no matter what. The benefit of them giving you the option to pay it off over time, and I just said they marked them up $50. These are probably really expensive shoes. Is that they get to charge you more on top of that. So it makes them a greater profit. That's the whole benefit of extending credit to somebody, is you can charge them for it and make more money. Any questions on that so far? So Heather wants an electric guitar, and she has the price of the guitar with the tax is $2,240. Okay, so she knows this guitar is going to cost her $2,240, and she can afford to put away $90 a month to save up to buy it. So we want to figure out how long would she have to save. And this is the process, by the way, if you're trying to decide whether or not to finance something or save for something. You figure out how much you can afford, you figure out how long it would take you to save, you look at the installment plan, you compare the two, and then you make a decision. So if she's saving $90 a month, how long will it take her to save up for it? Well, we're going to take the cost of the guitar, we're going to divide it by that $90 a month that she can save, and it is going to take 24.9, so 25 months. Just over 2 years for her to save up for this guitar. Okay. Well, she talks to a salesperson at the music store that thinks that she should do an installment plan. And that requires $15 down. And then you pay the remainder with the finance charge on a monthly basis for 2 years. Okay. And she'll be paying $88.75 a month for 2 years. Okay, so first we need to figure out, well, what's her down payment? So she has to pay 15% down. Okay, that's going to be $336. She has to pay that right up front. Okay, and then she's paying $88.75 for 2 years. 2 years is 24 months. She's paying $88.75 a month. She's going to pay $2,130. So she's paying $336 and $2,130. Paying a total of $2,466 for this guitar, which means her finance charge is $226. This is the decision you have to make. I can pay $330 down. I can pay $88.75 a month, which is in the $90 range that she could save put away. Is this guitar worth it to her to pay an extra $226 for it? That's the decision that needs to be made. Is it worth it to pay this much extra for this guitar than if I just pay for it already? Trying to increase sales because carpet's expensive. On average, I think it's like $2,000 to $3,000 to carpet a house. So they're making all purchases can be paid on an installment plan with no interest, as long as you pay it off within the first 6 months. There's a minimum of $20 monthly payment. Okay. The Schuster family buys carpet for $2,134, but only makes the minimum payment for 6 months or for 5 months. How much would they have to pay in the 6 months to not pay a finance charge? Well, we're paying $20 a month for 5 months. So they paid a whopping $100 towards their carpet purchase. So they still owe $2,034, which they would have to pay on that 6th payment in order to avoid finance charges. And this is what they count on. Okay. If you wanted to pay that off in the 6 months and not have to pay a finance charge, what you would really want to do is you want to take that $2,134, divide it by 6, and pay that $300 and whatever it is every month. But what they count on is that people won't do that. People go, oh, I only have to pay $20 a month. Woo! And they pay that $20 a month. And that time period where you're not paying interest runs out. Because you only paid $100 towards your carpet. So now you still owe $2,000, and now they're going to charge interest. Because you're going to get to that 6th month, and you're going to be like, oh my gosh, I would have to pay $2,000 this month to pay this carpet off. I don't have $2,000 sitting in the bank. Or maybe I do, but I don't want to spend it all on carpet. So that's what they kind of gamble on. That's why they'll do those no interest for however long things, is because they're gambling that you won't actually be smart about it. They're gambling that they're smarter than you are. Now that you've taken this class, though, you'll be like, haha, I know how that works. I'm smarter than you. I will split that divided by 6 months. I'll pay more than the minimum monthly payment. I'm not going to pay you a dime in interest. Haha. This one is kind of questionable. Okay, it depends on who you're talking to. Good is anything that's 700 and up. Okay. Excellent is over 770. Risky or poor, depending on who you talk to, below 650 or below 600. According to our book, below 600. But they won't even possibly consider looking at you for a mortgage unless your score is over 620. Okay, so they're considering 620 to be too bad, bad, really risky. So I would say between 600 and 650, you're on the borderline of really poor credit. You want to be over 700. If you're over 650, you're in a good position to be able to improve it to 700. If you're below 650 and you're below 600, it's really difficult to bring your credit score back up. Because once you get to this area, the only way to improve your credit score is to improve your credit history. And that means paying things on time and being responsible with your finances and things. But if your credit score is already that low, nobody's going to give you any loans to pay on time. So it becomes very difficult to fix it. Does that make sense? So Mike has a credit rating of 720, and Tyler has a credit rating of 560. Mike and Tyler apply for identical loans from Park Bank. Mike is approved for a loan at 5.2% interest. And Tyler is approved for a loan that is 3 percentage points higher because it is bad credit. That's the other thing that poor credit will do to you, is it changes your credit, your interest rates. So if you go to the car lot, let's say for example, and they have those no money down, 0% financing, that's only for people in the excellent range. People down here in the risky and poor range are going to get like 15% financing, not 0%. Okay, so Tyler's got 3 percentage points higher. So Mike is at 5.2%. We're going to add 3, and he's going to be at 8.2%. Okay. If they each take out $3,000 over 3 years, what is the amount of interest they will pay? We're going to consider this to be simple interest because it did not state otherwise. So interest, this is why I said some of you that haven't been in here might want to go back and look at the stuff from last month. Interest is principal times rate times time. So Mike is going to borrow $3,000. His rate is 5.2%. You have to move 2 places to the left, so it's 0.052. That's what we're going to multiply. And times 3 years. And then Tyler $3,000, but he's at 8.2%. So move 2 places, so he's at 0.082 times 3 years. Okay, so those are the 2 calculations that we are going to have to do. Mike's interest, once I multiply those 3 things together, is going to be $468. So he's going to pay $468 for that $3,000 loan. When I multiply Tyler, same loan, 730. Tyler's going to pay $738. Same amount of money, same amount of time, different interest rate equals $300 more money, more in interest. So if you have bad credit, you will pay more for the same thing. So it's very important to guard your credit rating. It's vital. Okay, so your promissory note is the legally binding agreement that you make whenever you take out a loan. And you sign it, and it can be with a bank or a finance company, credit union, whoever's making out the loan. It states all of the conditions of the loan, length of the loan, interest rate, whether or not the interest rate is variable or fixed, monthly payment information, penalties, like anything that is part of the loan agreement will be in the promissory note. You want to read it carefully before you sign it because it is legally binding. So you want to make sure you read it very carefully. If you find yourself taking out student loans in the future for college, you will sign what's called a master promissory note. And the master promissory note means that you don't have to sign a promissory note for every single semester that you're in college, because every single semester you're in college you get a separate loan. It's not one loan for all of college, it's different loans every semester. Sometimes 2 different loans in the same semester. So you sign a master promissory note which covers all of them, so you only have to sign it once. So you don't have to sign papers every single time you get student loan money. Bless you. The principal is the money that you're borrowing. Just like in when we did banking, the principal was the money that you put in and that you earned interest on it. If you're talking about loans, the principal is the money that you're borrowing that you're paying interest on it. So it's basically, the principal is always like the base money. Okay. Cosigners. Sometimes if your credit is not good enough, either you have a low credit score or you don't have enough of a credit history, and you want to take out a loan, you need a cosigner. The cosigner is making a very large and gracious decision on your behalf if you should get one. Because when they cosign on your loan, what they're saying is, if he or she does not pay this loan, I will. That's kind of a big deal. So should you ever have a cosigner, be sure you pay your own loan, because otherwise they're going to have to pay it for you. Like, so if your parents cosign on a car loan for you and you don't pay for the car, they have to. So it's kind of a big deal. Sometimes creditors will require life insurance to be part of your loan agreement, and that will cover your loan in case of death. So let's say you take out a mortgage and your creditor requires life insurance, it'll be part of your mortgage payment, the life insurance payments, and then should you die, that life insurance policy will cover the mortgage. It's not very common that they require life insurance, but it is very common that they will offer it. Most major credit cards offer some sort of life insurance or disability insurance. Should you not be able to pay the bill, then the bill will be covered for you, kind of insurance that gets added to your monthly payment. They don't all require it. It's rare for it to be required, but it's usually offered. Do you have questions, sweetie? Down here at the green, it says Truth in Lending Act. The Truth in Lending Act requires that the promissory note has to contain all of the information about the loan. There were some issues several years back. I don't remember the exact dates, but it was quite a while ago, where there were some really sketchy loan practices happening, and variable rates on the mortgages or balloon payments that were not disclosed in the paperwork that people were not expecting, causing all kinds of problems. And so they passed this law that the promissory note has to contain all of the information. If it is not in the promissory note, it can't happen. So they can't, unless it's in there, they can't change your rate, they can't give you a balloon payment unless it's in the promissory note. So that's to protect the borrowers from unfair lending practices. The banks, you have one or the other of these first two, either a prepayment penalty or prepayment privilege. It'll be in the promissory note. So that's another reason you need to read these very carefully. A prepayment privilege allows you to pay off your loan early. So you can either make larger monthly payments, or you can make extra payments, or you can make a big giant payment at the end and pay it off early. And what this does is it reduces your interest, because your interest is charged on a monthly basis. So if you pay it off early, you don't pay as many months of interest, you pay less interest. Now, the prepayment penalty occurs if the lending institution does not want you to do that. Now, legally, they're not allowed to tell you that you can't pay it off. They are allowed to charge you for it to make up some of the interest that they would lose if you do pay it off early. So a prepayment penalty is a fee that they will charge you if you pay it off before the due date. So prepayments reduce your overall charges, and you can see why some institutions would not want that to happen, because that takes away their money. And so whether or not you're allowed to pay things off early or not will be in the promissory note. That's another reason to always read it, because if you don't know, and let's say you have a house payment of $560 a month, and you just decide, I'm just going to pay $600 a month, and I'm going to pay this off early, They're not going to tell you that whole time you're paying the $600 a month, you're paying it off early and you're getting there and you're, yay, I'm paying it off early. Then at the very end, when you think it's finally going to be paid off, they're going to charge you that fee because you paid it off early. And there's a fee, there's a penalty. So you want to know going into the loan if you're allowed to pay it off early or not, so that you don't make like a mistake like that if you're not allowed to. If you are allowed to, then you go for it. If you're not allowed to, then you don't. There are two different kinds of ways that money can come out of your paycheck. There's an assessment and a garnishment. An assessment is a positive thing. You made a decision for your own easiness or for whatever that I'm just going to have this come out of my paycheck. And so it's like a direct deposit, but it's a direct deposit to your creditor, maybe for your car payment or your mortgage or something. And every month comes out of your paycheck, that payment, and it just goes straight to them, and you don't even have to think about it. You don't have to write checks, you don't have to pay, it's just done. So that's what a wage assessment is. And the creditor and the employer have to agree because the employer and the creditor have to set it up through your paycheck, for the money to come out of your paycheck. Now, wage garnishment is a negative thing. So wage assessment is good, that's voluntary, you decide. A wage garnishment is bad. That's been court ordered. So wage garnishments occur when you haven't been paying your bills and you've been sued. And then the courts order that money will be taken out of your paycheck to pay off your creditors. I would have to say the probably most number one reason for wage garnishments in the United States is most likely child support issues. The number two one is credit cards. So those are not great. And then a balloon payment. A balloon payment is the last payment on some loans. So it almost never works out that you're paying a loan for however many years, 5 years, let's say, and the last payment is the exact equal amount to the other payments. So what they'll usually do is, let's say your payment every month is $300. And then if you paid the next month $300 and the following month would be $125, they're not going to have a $300 and $125 payment. Some of them will put those two together, and so your last payment will be $425 instead of $300. Sometimes balloon payments can be really high. Like we're going to let you pay these kind of low payments through the whole term of your loan, but then at the end, your last payment is going to be like $4,000 to pay like off more interest or something. So again, that's in the promissory note. They have to put that in there. So if your last payment is going to be higher, it has to be in there for them to do that to you. Any questions on that stuff? Any organization that extends a loan is a lending institution. So you've got banks, credit unions, consumer finance companies, life insurance companies. Your banks are your most common loan provider. Two types of banks. You've got savings banks and commercial banks. Savings banks have good interest rates, but you really need good credit. And then commercial banks loan money to businesses. They have a lot of money to lend, but you need good credit. Credit unions are members only banks. The membership requirements vary, and they have lower interest rates than your average bank. But you do have to be a member in good standing to even apply for a loan. Consumer finance companies will pretty much lend to anybody. They'll lend to people with low credit, but high interest rates. You guys heard cash advances. You guys have all heard the commercials for cash advances, right? You write a check for a payday loan. The average charge on a payday loan is like $50, right? Not a big deal. If you work out the interest on that, it's about 400%. So they'll loan you money. They'll loan anybody the money. Really high interest rates. Payday loans are an extreme example. Those are about 400 or 500% interest. Excuse me. But typically, if you're talking about a consumer finance company, you're taking out a loan that's not a payday loan. You're looking at 25 to 35% interest, which is really high. Life insurance companies, they make loans to people that have whole life policies. The amount you can take out depends on which policy you have. And the interest rates are really, really good because you're borrowing your own money. You're taking money out of your life insurance policy and you're paying it back. Pawn shops. You can get small, quick loans based on the value of your collateral, your assets that you take in, that you leave at the pawn shop. So if I were going to pawn these ice breakers, I'd take them to the pawn shop. They would tell me how much they thought they were worth or how much cash they were willing to give me for them. Well, first they're going to ask me, are you selling or pawning? There's a difference. If you're selling it outright, they're going to give you a little bit less cash for it. If you're pawning it, they're going to give you a little bit more because you're going to come back and buy it back from them and get your stuff back and give them back their money with a fee. Okay, bad rates, though, very bad rates. Very high interest, and 30 to 90 days maximum on a pawn. If you don't pay it off in that amount of time, they sell it. So you lose out on whatever it is you had. Your collateral, they will never give you anywhere near as much as it's worth. So if you take in a ring that's worth $200, you're probably going to get about 60 for it, maybe 75. And that's only if they can sell it for 200. Collateral is your personal belongings that you put up in exchange for a loan. If you're talking about a pawn, you're not going to get as much as the value of your collateral. But when you buy a house or a car, the house that you buy and the car that you buy become the collateral of the loan. The bank actually owns those until it's paid off. You just get to use them. Okay, and we're going to stop there for right now. Hold on. I need to write down homework for you.